Well, hey there, everyone. Happy Friday, January 23rd. I'm Dave Keller, and welcome to Chart This with Dave Keller. Good to be joining you here from a sunny and beautiful Redmond, Washington. It's a little bit chilly for Seattle this time of year, but I know I have very little to complain about. I know many of you from Texas up to New England are facing some pretty serious weather conditions here going into the weekend. I wish you safety and peace and happiness wherever you're at. Stay warm, bundle up, be careful out there. We're somehow fortunate in the Pacific Northwest, not really being affected by this one, but I know many who are. So hang in there. This too shall pass. But for now, let's warm up our brains with a little bit of discussion about charting and technical analysis here. We've got a great mailbag show to share with you today. Some really good questions that have come from viewers like you over the last week. Dropping questions on our YouTube channel. We appreciate you so much watching. Appreciate you engaging with me and with my team through the comments section on our YouTube channel, and really appreciate these great questions that I'm able to feature on the show today. We're going to start things off with a brief update on the market conditions. Kind of a choppy, flat day here. This is one of those where the indexes were mixed. You had the Dow down for the day, the NASDAQ up. The S&P essentially unchanged in the middle, really kind of choppy sideways session. Volatility remaining low. The conditions are sort of similar, right? We've had the run. Now we're really not arguably in an aggressive uptrend anymore. This is a consolidation phase more than anything. This is a sideways market condition. And I think we're seeing that evidenced in measures of breadth and such that are less extreme, but more kind of in the middle, right? Momentum readings more in the middle, more neutral. Some mixed results looking at sectors today, for example. And the heat map looks pretty modeled, kind of a big mixed bag of things. All right, we'll hit the recap real quick. We will go into some of the questions, and please keep the great questions coming. Starting with the market update, here's the chart of the S&P 500, and on stock charts they have a 2-day kind of little preview chart. And I love this just as an initial assessment of what's happening today versus what happened yesterday. And if you wonder why have a 2-day chart and not just today's action, so you can see a little more clearly, it's because so many times, at least in my experience, number one, it's good for context, right? It's going to understand what's happening today versus what just happened. And ideally, we're looking at longer term charts too, so we can put today and yesterday into appropriate longer term context. But just for an initial assessment about what happened today, I think it's helpful to understand that today, right out of the open, we ended up making a low for the day right around yesterday's low. We rallied into around 11 a.m. Eastern, which ended up being the high for the day. That was almost exactly at yesterday's high. Then we kind of went down to test the previous low, didn't quite get there. We rallied to test today's high. We didn't quite get there. We literally ended up in the middle. So sort of a triangle shape to today's action, and today's high and low match very, very well with yesterday's. And we revolved around yesterday's close. So that, I think, is a perfect case study, right? An example of why it helps you to pay attention to yesterday's close. It helps you to pay attention to yesterday's range and yesterday's movement, because that can help you understand if something's different today. What I learned from yesterday to today, no real change. I mean, what happened yesterday is kind of the same exact thing today, kind of a range-bound, choppy market, no change in trend, no change in, breaking through support or resistance. This was really more remaining within mid-range of where we've been the last couple of days. The NASDAQ was slightly higher. The Dow was slightly lower. Mid caps and small caps both going kind of risk off here. Small caps we've talked about, and we've covered that resurgence in the small cap sector. Today, however, and I think yesterday as well, small's coming down. The mid cap trade underperformed the large cap stocks, and the S&P 600 small cap index down 1.8%. The VIX remains fairly low. I mean, it was a big spike in the last 10 minutes of trading, which got us just barely above 16. But this is the options market basically pricing in very small day-to-day changes in the major averages. Rates, similar, kind of choppy, but no significant change. The 10-year yield finished the week right around 4.25. The TLT, which is a bond ETF, ended up finishing positive for the day, up about just less than 1/3%. The dollar trending steadily lower through the course of the day today. That dollar chart might be a really important one. That's one we didn't pay a ton of attention to, just because other things I felt like took a higher priority. But if we get a big rotation in the dollar's generally been trending higher. We get a bit of a downside rotation in the dollar. That could be a shift that we really want to certainly try to understand and dig into a little bit deeper. Gold and silver, along with the rest of the major commodity ETFs tracked here on stock charts, all in the green. Silver up 6.6% today. Gold up another 1.4%. Both of those making new highs this week. Bitcoin quite choppy. So while it did rally up to around 91,000, currently trading around 89,500, that's essentially flat, similar to the flat nature of the S&P 500 chart. You can see the rest of the major coins essentially neutral today, kind of flat generally. The 11 S&P sectors, 7 of them finishing in the green. You can see materials ended up taking the top spot. The XLB was up 0.9%, staples up 0.8%, communication services up 0.6%, about the same for energy, which just had a pretty good week here. On the downside, financials, the worst performer, and earnings in the financial sector have not been particularly good. I was looking at the chart of Goldman earlier, still making higher highs and higher lows, but sort of weakening going into the end of this week. XLF was down 1.4%, followed by industrials and healthcare, which are your next two sectors. Look at the breadth in the small cap index, the S&P 600. 89% of that index was down today. 82% of the mid cap index. So when we talk about large over small, this is one of those days where those differences were pretty magnified. And you can see that small caps and mid caps generally went pretty big time risk off today. On the major large cap indexes like the S&P, still negative breadth, but not as significantly bearish. On the S&P 500, 70% of that index was down, 65% of the New York Stock Exchange. So the breadth has generally been okay this week, arguably pretty decent, but not today. Today risk off in terms of the breadth conditions. The Magnificent Seven and friends, we are happy to tell you that Microsoft bounced higher today to finish the week up a bit on Friday here, up 3.3%. Netflix, which remains, I would argue, undeniably in a primary downtrend, up 3.1%. So a nice bounce off of the new low. Amazon up 2.1%. On the downside, Broadcom, the worst performer, down 1.7%. Alphabet and Apple both down slightly, but less than 1%. The chart of the S&P, we won't talk too much about it, but kind of a choppy week, right? This week had kind of a couple different pieces. Now, this is a shortened holiday week. So coming out of that long holiday weekend, we had that big gap down on Tuesday. And Tuesday at the close, it felt like this might be a really ugly week. And I remember on Tuesday's episode, we're really thinking about, all right, that's a big close below the 50-day. Do we get confirmation on Wednesday? So anytime we have a big break of key support, my immediate next question is, do we get confirmation, right? To the next day, do we get some validation that it wasn't just a one-off momentary drop, but the beginning of something more significant? Are additional sellers kind of jumping in, or in this case, jumping out of stocks? Wasn't the case, right? Wednesday was a nice upside reversal. Thursday and Friday was a gap higher, but Thursday and Friday basically flat. And what's interesting is yesterday on the show, we talked about this doji candle where the open and close are identical, and it's an indecision candle. And sure enough, today, almost an identical trading day, very, very similar, sort of remaining within that range. So, open question what we get going into next week. Quite a few companies reporting earnings. We'll be digging into some of those charts with our Market Misbehavior Premium members for sure. But that's where we're at here. All right, we're going to bring up the first question in a moment. I do want to let you know we had 2 episodes of the Market Misbehavior podcast this week. I told you earlier about Joe Rabel of Rabel Stock Research. Fantastic discussion about multiple timeframes, about using the ADX line, which is an indicator he uses often. I don't nearly as much, but I'll let him explain to you how it's so valuable. Some really interesting takeaways from that conversation, along with process, just how to approach things. And then just earlier today, released the last episode so far of our Market Misbehavior podcast with Ted Hicks. Ted is a portfolio manager based in North Carolina and an author of a book called Evidence-Based Investing. I joked with Ted, that is a book I wish I would have written. It's an easily digestible read. It hits on a philosophy of investing that jives so much with how we talk about the markets and how I think about the markets and address them. Interesting thoughts about process, about top to bottom investing, how to think about diversification, which was a really important set of discussions we made, all about price momentum. And if you're an advisor, I think you might really enjoy hearing a practitioner talking about how he uses technical analysis as a way of enhancing relationships with his clients. So check out both of those on our YouTube channel, of course, on all the podcasting platforms as well. Do you want to tell a couple thousand of your friends to listen to it as well? Hey, I wouldn't mind that. That'd be fine. Let's get to our first question here. And thanks again. These are all questions from viewers like you. I appreciate them greatly. Question 1, in terms of chart analysis, do you use any different tools or techniques to analyze a composite chart like the S&P or the NASDAQ versus a single stock chart like Apple or Intel? I love the question. I mean, I love the way that you're thinking about this. And this shows like a more evolved level. It sounds to me like you're kind of past the basic level and you're getting into, really applying technical analysis to different things. And I applaud you for that. And good to think about. I think it's less about the technical approaches. And I would say technical analysis, particularly on the timeframes we're talking about, particularly when we're talking about trends and momentum, these are pretty much ticker agnostic, meaning the idea is you could apply these same tools and techniques, right? If you look at what I'm showing here, moving averages, RSI, price momentum, you could run that on a commodity, on a currency, on a future, on an index, on an equity, on an ETF. It doesn't matter, right? As long as there's good price data, it works just fine. So the limiting factor isn't what asset class you're looking at, or whether it's an index or an individual equity. It's more making sure it's liquid enough, right? So a really illiquid equity, right? Like a pink sheet stock, an over-the-counter stock doesn't trade very much. There's just not going to be enough price data to really gauge investor sentiment and create an indicator like RSI, right? So that's the constraint is more liquidity, right? So an ETF that's smaller, that doesn't trade as often, right? Doesn't have a lot of assets under management. Technical analysis may be a little less valuable just because you don't have enough data to really do it. Assuming you have enough data, I think it's less that and more the types of indicators that would make sense. So I did not mention relative strength at the bottom, which is the stock versus a benchmark in this case, right? Is what we most commonly do. You can use that on like an industry ETF, but like on the NASDAQ, I don't know if the NASDAQ to S&P ratio is something I would necessarily pay attention to for that. I mean, I do look at that when I think about growth versus value, but in terms of, analyzing the NASDAQ, I don't know if that relative line would mean as much to me. So, things like relative strength, what else would be sort of equity specific, right? Some of the options related data maybe would be more, equity specific, but it depends, right, on what you're looking at. And then with the NASDAQ and the S&P, you have the benefits of looking at things like breadth data and, looking at the index members and relating those to what you see with the major indexes. So I would say there are the tools and techniques that would be unique to those would be things like breadth data, any member-based data on the major indexes for single stocks, relative strength, and what I mean, relative performance, I think becomes much more crucial because you really want to understand how a stock is trading relative to an index, relative to its sector, and you've got a lot more things you can think about there. But in terms of the basic tools and techniques that we feature on the show every day, it's really, ticker agnostic, as I would say. So the idea is these techniques are going to work pretty well on anything. Now, what you have to remember, though, is the advanced level as you start to think about how does a biotech stock trade versus an energy company versus a gold stock versus an AI name. And those just trade very differently in terms of volatility and things like that. So certain indicators may be better or worse for certain sectors on certain timeframes, but that's really more of we'll save that for a later discussion. That's how I would answer that. Great question though, and I appreciate you thinking about trying to customize a little bit based on what you're looking at. I think there's a lot of wisdom in that question. Next question: thoughts on Starbucks and the golden cross and/or its upward trend? Fair question. Let's take a look at Starbucks. Yeah, so Starbucks, a great Seattle-based company here and a nice rotation higher. I mean, I think what's interesting about the chart of Starbucks, I would say, has been the shift from a sideways trend or a consolidation phase to what appears to be an accumulation phase. And you had mentioned like the golden cross in particular. I can't tell you how much I don't pay attention to that. As a matter of fact, I didn't even know that it was a golden cross until I saw your question. Then I looked at the chart and I'm like, oh, it is a golden cross. So why don't I pay more attention to those? If you actually would backtest, if you go through the trouble of backtesting on a platform like Optima, which has really good backtesting and signal testing capabilities, if you backtest a classic golden cross, right? Let me buy when the 50-day crosses up through the 200-day and sell when the 50-day crosses down through the 200-day. What you will find is it's just not a great way to trade stocks. And you can just see it on the chart of Starbucks, right? I mean, the most recent signal before this, what we call a golden cross, which is a bullish crossover, would be here, which was a bearish cross, or what's called a death cross. It happened right here. I mean, if you look, that was pretty much 2 days, 3 days after like the low. So the last thing you wanted to be doing there was selling. You, if anything, would want to be waiting, but if not, you probably want to be buying, because we've bottomed out and rotated higher. So especially with a chart that's more sideways, that kind of traditional crossover technique with those particular combinations can be super unhelpful. And so I would say the 50 and 200-day, I often get asked about the golden cross or the death cross because they have catchy names and stuff. I can't tell you, out of all the things I look at, that is probably the least helpful tradable signal. What I do find more helpful, where is the price relative to the 200-day moving average? That has helped me many, many times to recognize short-term swings as a swing trading approach, super valuable. Looking at momentum and what happens after a breakout. So if you look at what happened here, I think the reason why I'd be more encouraged on Starbucks is not this golden cross. It's the fact that we broke above the 200-day, but then the momentum has broken out. And in the last week and a half, the RSI has finally pushed above 60. After June, July of last year, like we never got above 60 here as the stock is going sideways. So kind of neutral momentum. And that tells you there's just a lack of buying power. And then that changed here in January. From the end of December, it's been almost an uninterrupted uptrend, and the momentum has gotten better and better. We're currently overbought with an RSI above 70, which just says we've gone up a lot. That's been a pretty good run. So I would say what impresses me is more of the change in phase, right? The fact that we've gone from what I would say is a sideways or consolidation phase into a new uptrend phase or an accumulation phase is what I would tell you. And the momentum supports that change of character. And with strong trend and strong momentum, usually leads to strong relative performance. And all of those things are how I can describe Starbucks in January of 2026. Good chart, getting better for now. And I think holding the break above the summer highs from last year would be pretty good. Next question. Dave, what do you think about the utility sector no longer being a defensive play because of all the new energy infrastructure companies in the market? No, it's an absolutely spot on question. This is sort of a shift that I picked up on in others, and I don't even remember going back who initially shared that with me, because I talk with a lot of people through the course of the week, just in the natural process of what I'm trying to do, and just exchanging notes with others and interviewing people and stuff and being on other programs. And I remember first hearing that, and it was when utilities and technology started to be correlated very closely together. And it's like, hold on, technology's offense or growthy offense, and utilities is a boring defensive sector. And then I remember, the first thing I read, and I don't remember who it was, and I apologize, I would give you credit now, but I remember that first article that pitched this idea of, utilities, it's because of the energy requirement. And the specific thing that stood out to me, the moment when I realized this was a thing, this was earlier, and I don't even remember when it was. I want to say it was like spring of 2025, but I don't know if that's the right timing. But it was somewhere in there that the article talked about, it measured the number of earnings releases in the one quarterly earnings cycle, and how many utilities mentioned AI and the infrastructure needed to support AI. And it was like one company out of all the utility companies in the S&P 500. And then the next quarter, it was like 90% of them plus talked about AI energy requirements and how they were building up infrastructure to match that. So it was like in one quarterly cycle of earnings, it went from kind of no one talking about it to everyone talking about it. Everyone was getting questions about it. And then the correlation between technology and utilities was all of a sudden very, very high, because the strength in technology was being supported by this, the infrastructure needed when we all started to realize that was a thing. So that's one. So that I think has been a well-trodden path of reality, I think, which is fair. And I would say one other comment about it. So do I think that makes sense? 100%, right? Utilities in a lot of ways. I think that's That's going to be one of the key. That was an important trade in 2025. That's certainly going to be an ongoing story in 2026. I think now, I mean, in 2026 and beyond, it's going to be about all the companies that have made aggressive spending into AI infrastructure. Does that translate into earnings, right? Does that translate into revenues that can somehow compensate for the billions and billions and billions of dollars that have been spent by these companies to, build out the infrastructure? And that, I would argue, is still not clear. I heard Kathy Wood of ARK Investing earlier this month in Tampa. She is 100% sure that is all, that these companies are all making tons of money and their earnings are going to come, and it's obvious. I don't think it's that clear, and I don't think everyone is going to have great outcomes necessarily. We'll see. We'll see what happens, right? And I think that's where, with any of these sorts of aggressive spending for infrastructure, there's not an immediate payout. I mean, you're taking a big hit for the hope, for the potential to, really profit from those investments down the road. And I don't think there's a clear path or an obvious path where that happens, certainly for every company that's been spending so much on infrastructure. So those are some thoughts on that. I would say the other thing is, remember, on my charts, I group the sectors in 3 simple buckets. I try to simplify as much as I can. And so I look at the 3 growth sectors: tech, communications, and consumer discretionary. I think of 4 kind of value sectors: industrials, financials, materials, and energy. And then I think of the 4 kind of traditional defensive sectors: utilities, healthcare, consumer staples, and real estate. But with those buckets, I'm not implying that they all move together all the time. They often do, right? So if you look at the general performance of these defensive sectors, you can see they generally move together. But October, November of last year, healthcare looked really good. Utilities did not, consumer staples did not, and real estate did not. So healthcare sort of went on its own thing. And so I think, remember, with regulatory changes, with shifts in earnings, with costs, the supply chains, just regulatory changes in general, geopolitical events, I mean, these sectors can divert from the default of following the other kind of similar types of sectors. So these 4 sectors tend to be defensive. These tend to be lower volatility. These tend to be higher yielding sectors. So when investors are getting nervous, they often go into these sectors. But that doesn't mean that they're all going to move together. That doesn't mean utilities can't diverge from the rest of these at some point and do better or worse, depending on how their businesses are evolving along with broader market themes. So I think that's fair. And, for what it's worth, utilities over the last 3 months clearly underperforming. And that's been a bit of a change compared to early 2025, when it was one of the better places to be. All right. Thanks for those questions. We've got a couple more to address with you here in a moment, but as a brief pause, I just want to thank one of our partners, Koyfin, for supporting market misbehavior. Koyfin is a platform that I use every day. I met the founder of Koyfin years ago in New York, and we chatted about his plans. And he talked to me about building a light version of Bloomberg, for lack of a better description, really optimized for financial advisors, but accessible to a lot of people and at a decent price point. And I kind of was like, okay, right, because I've seen a lot of kind of Bloomberg killers come and go, things that claim to be a great low-cost option that never materialize. This is the first one that I've seen that actually gets close to that, that claim. And while it doesn't do everything that an institutional system like Bloomberg would do, it does quite a bit. I use it all the time for ETF holdings. So if I want to dive into a particular ETF and think about how it's concentrated, what bets it's making, that's what I do on Koyfin, because it has great ETF constituent data. International markets, because I will randomly, not all the time, but a lot of times I'll be asked to look at Italian stocks or Indian stocks or Japanese stocks, and that's my go-to platform for international markets because it has great coverage. And other asset classes, right? Things like the fixed income markets, which I miss having deep fundamental data and structural data about the bond markets. Koyfin does a pretty good job of covering that, along with a lot of other fundamental data that I don't even scratch the surface of the capabilities, because it's not part of what I do day in, day out. I will say, specifically for advisors, great tools to enhance your discussions with clients, things like client portfolios you can access through the platform, model portfolios, so you can share those with clients and sort of build that relationship based on deeper understandings of what's happening in the market and how it's impacting your client's performance. You can find more information at marketmisbehavior.com/Koyfin. If you use my link, you get a little better deal, and it helps me to make market misbehavior awesome. So I'd appreciate you checking it out, particularly if you're an advisor. I think they have some really good tools that could help you grow your business and enhance your relationship with clients. Marketmisbehavior.com/Koyfin will give you more info on their capabilities. All right, let's get to another fantastic question. Again, please use the comment section on our YouTube channel for questions. Would love to hear from you. Next question, do you have any tips for studying for the CMT exams? How did you find them? What have you gained from it? I'll be doing my level 1 exam this summer. So congrats and good luck with level 1 exam. If you follow what I do on the show, I don't want to guarantee you're going to pass the exam, but things we talk about should get you pretty well prepared, because it's more of a basic building block kind of assessment of understanding the best practices of technical analysis. Please study a lot, because they're not easy exams necessarily, but that's the kind of thing I think what you hopefully would be. That's not meant to be an incredibly impossible exam. That's pretty decent pass rate. Level 2 and level 3, the pass rates get a lot lower because it's a lot more challenging and a lot more information to combine. I found the CMT exams fantastic. Now, I took them 20 odd years ago, so they've changed quite a bit. As a matter of fact, when I was doing the level 3 exam, they just had changed. It was either the first or second administration that they changed to an electronic exam as opposed to the handwritten exams. That's dating myself just slightly, but it was still pretty awesome. And the level 1 was still the little, whatever you call those, filling in the bubbles. And level 1 and level 2 were like that for me. So I found it fantastic because it's a structured way of learning technical analysis. You learn about a bunch of stuff. And that helped me. I knew I knew candlestick analysis really well because I had a couple clients at Bloomberg that used them all the time. So I'd learned them already just to be a good, supporter of what they were doing. But other things I didn't understand at all. And I learned a ton about like intermarket analysis and other things that I really didn't understand before taking those exams. I came out of it with a much better structured approach to analyzing the markets, much of which is reflected here. Do I have any tips for studying? Do I have any tips for studying? Yeah, I mean, number one, they have a really good self-study program that's built into it. Optima, which is a charting platform you'll get access to when you sign up for the exam. Matthew Verdow at Optima has done a really good job, and his team creating educational tools, tutorials and stuff to help you, classes to help you study for the exam and pass the exam. And I've not taken them, but I've heard very good things. And I know Matthew and his team well, and they're pretty awesome. So I would check those out. Other things, honestly, in all the CMT exams, what I would encourage you to think about is that they always take questions, or often take questions, from the current markets, right? So I used to write questions for the exams. I have a number of times, and I used to grade exams. Haven't done it in a couple years, but when I did, and I was creating a question, I would look at the current market. I would look at charts I was using. So the reason why I'm telling you that is apply what you're reading, read a concept, and then bring up current charts. Bring up the S&P, bring up IBM, bring up Microsoft, bring up sector ETFs, because those are most likely what you're going to see on the exam. And if you've already analyzed those charts, just in your study process, it's going to be pretty easy to get the questions done very quickly in the exam. One of the things I did with a couple friends, and that would be my other tip, is find some other people either online or in whatever town you're in that are taking the CMT level 1 exam, whatever you're on, and form a little study group. I had a couple people at Bloomberg. We were all taking the exams at the same time. We would go into a conference room and say, all right, bring up a stock, candlestick analysis, and you do it, Elliott Wave analysis, and one person would analyze and the other people would critique. I learned a ton from that sort of collaborative exercise of analyzing charts together, and allowed us to cover a lot more than we would do on our own. Those are some ideas, but first, congrats. If you're a professional, if you're in the financial industry, the CMT exam, it's a professional exam. It has a work requirements. You have to be in the industry for a number of years before you can use the credentials. But it's never too early. If that's something you want to do, is be a financial professional, never too early to start taking the CMT and at least get the exams done. Next question, is Palantir forming a head and shoulders top? An open question, I would say, to be honest with you. I would say unclear at this point, but let's take a look at the chart together. So here's the chart of Palantir. So what's happened is, my default chart is 1.5 years, and that's just because of the time frames that I operate on. I've just become comfortable with having that be my starting point. But I'm often kind of zooming in or zooming out, depending on whether I want to get more granular or whether I want to get a little more big picture idea of what's going on. And you can do that by changing time frames. I also on stock charts use these little quick buttons to jump between like weekly and monthly charts. You can understand bigger picture trends about where a stock like Palantir has come from. I mean, it's amazing. I mean, this company is talked about so often. It IPO'd during the COVID era, something that is still a very young publicly traded company for sure. So the last year and a half, I mean, a huge run in 2024 and 2025. So the more recent data looks very compressed because on a log scale, these are pretty small percentage moves relative to the ones over here. So I'm going to zoom into like 9 months. And I think you're talking about this, right? If you look at the end of this, I think you're looking at this period and saying, is this a big head and shoulders top? So let's take a look at like 9 months and see. So what makes a head and shoulders top? So number one, you need a peak surrounded by lower peaks on the left and the right. So does this look like a head and a left shoulder and a right shoulder? So not exactly, because we kind of have the head and then we have like multiple shoulders. And we have kind of multiple we have like one shoulder over here. So it's a little lopsided right now. And what I mean is just to quickly, not to think how effectively can David annotate charts. I see it kind of like this way. So, I mean, could it be like a complex head and shoulders pattern, which is what you call when it's like a head and multiple left and multiple right shoulders? It could. Remember, with any head and shoulders pattern, one of the things that, a lot of times you will see something that looks kind of like a head and shoulders pattern. And I would say as a technical analyst or as a technically oriented investor, we want to get away from kind of analysis to more structured, more disciplined analysis. And the way we do that is by thinking about some of the specific rules, some of the specific criteria that really make something a valid head and shoulders top. So a couple things that I would say. Number one, with a head and shoulders top, there's this expectation of symmetry. So the left and right half of these patterns, if we folded over the pattern, they should line up pretty well. And if you have like a complex left half and a very simple right half, right? So if it would just break down, I would say not a great example of a head and shoulders pattern because it just doesn't follow the symmetry measure very, very well, right? It would not pass the symmetry test, because the left and right halves would be very different. If we continued and made like another secondary peak, so there were two left shoulders and two right shoulders, then I think maybe we could make an argument for that. The other thing that you want to remember is the neckline, right? So with any pattern like a head and shoulders pattern, you have a neckline, and this is probably my best approximation of a neckline at this particular moment. So when you think about the head and the left shoulder or shoulders and the right shoulders, you take the swing lows between the head and the left shoulders, right shoulders, and you connect them with the trend line. And that's called the neckline. So the idea is it's a confirmed head and shoulders top if and only if we violate the neckline. Until then, you can only call it a potential head and shoulders pattern, or a head and shoulders like pattern would be fair, but you can't call it a head and shoulders pattern. That only happens when the neckline is broken. That comes from Ralph Edwards and John McGee, who wrote a foundational book on price patterns in the mid 20th century. You can find that on my recommended reading list at marketmisbehavior.com. You should read it. If you haven't read it, you should have it on your bookshelf. That is required reading, I would say, as a technically oriented investor. But it breaks down a lot of really interesting things about price patterns. Some would argue, and even people have come on and dropped comments in my YouTube channel when I talk about a head and shoulders pattern, insisting that volume is included. Edwards and McGee make a big point of talking about how important volume is. And if the volume doesn't match a particular setup, then it's not a valid pattern either. I'm not that solid about that. I'm not a huge buyer on that one, only because I think volume means something very different today than it did 80 years ago, for example. But for what it's worth, that's another thing that could differentiate and that some people certainly use. A good example of a head and shoulders top recently is like a good one to save is like, okay, that's like the model. Dell is probably a good example. So Dell Head, and again, it's a bit of a complex-ish head because you have a couple different tops, but we'll let that go. Left shoulder, right shoulder, generally pretty symmetrical. You connect the swing lows between the two. We bounced off the neckline and then broke down through it. For now, we'll see if we have a valid breakdown and continue below that neckline. But if we would, that would be a confirmed head and shoulders topping pattern. So that's it. So with Palantir, still an open question. I think this neckline is something I would be watching. Palantir below 150, whether or not you call it a head and shoulders top of some sort, certainly not bullish, I think is how I would say it. All right, last question. We'll make it a quick one. Oh man, it's not quick. I'll give you the quick version. What do you think about Elliott Wave theory? Would it be helpful to incorporate it into our daily index analysis? Whether it would be helpful or not, I think that's a question for you. Do I use it every day? I do not. Do I use it often? I definitely don't. Do I use it occasionally? I do. And here's what I found, right? I often get questions about specific indicators, and I'm asked, do you look at blah? And the answer is, you just can't look at everything, all right? I mean, I'm one guy, and I'm running a business, and I'm analyzing markets, and I'm doing interviews, and I'm going on, financial media. Like I can't use every technical indicator. So one of the benefits of the CMT program that I found, going back to an earlier question, was just it exposed me to a lot of different styles of investing, of technical investing. So I learned about candlestick analysis and Ichimoku clouds and trend following and momentum and sector rotation and intermarket analysis and Elliott Wave and GAN and all these different things. I use some of those things every day. And I think when you come out of that course of study, or when you come out of your own learning experience, and as your experience progresses, you will find certain things that click for you. For me, RSI, the moment I learned about it, I was like, this makes sense. I get the idea of momentum. I like how that helps me identify shifts. I like how I can use that on different time frames. This is an indicator I'm going to end up leaning on, and books by Connie Brown just help me upgrade more and more how I use it. I look at it all the time. I mean, hundreds of times a day, I'm looking at the RSI for a particular stock or ETF. Elliott Wave for me is in another bucket, which are things that I think are interesting, but not central to what I do. They're things that I might refer to if the chart has a particular look. Things like an ABC correction, the idea that after a big run, you have a three-wave pullback. I'm not a big buyer on all the nuances of Elliott Wave theory, but I've seen enough three-wave pullbacks that jumps out at me. And if you want to call that Elliott Wave, you're welcome to. I just call it thinking about that ABC pullback and recognizing that that is often a way that a market will pull back. There's often some symmetry there. And Elliott Wave just puts a lot more structure and a lot more discussion about that. My challenge with Elliott Wave is I think a lot of times it's something that becomes clearer way down the road. Like way down the road, we can see what particular wave pattern was happening. The idea of using the wave structure now to project an ideal future path, that is not something I do a lot in my own work, because I'm not trying to predict what's happening a month or two down the road. I'm basically trying to bet on the trends that I'm observing today. Other people that are more, betting on those sorts of things use Elliott Wave and seem to be doing just fine with that. So that's great. So what I do with things like that is I either don't bring them out often, but then just when the opportunity seems like it's a good time to do it, or for me, I've networked with people that are big Elliott Wave analysts, and I randomly talk to them. Jeff Hughes is one that I brought on my podcast, and I've interviewed a number of times. I don't always agree with everything that Jeff thinks is maybe going to happen based on a wave pattern, but it always makes me think. And that's what I found the biggest benefit of Elliott Wave. Two things. Number one, it stretches your thinking a bit, which I'm a big fan of. And number two, there's a big behavioral aspect. If you read books by Bob Prechter, by Steve Poser, they do a really good job of talking about the behavioral implications of different phases of the market. I think that is actually the underappreciated part about Elliott Wave theory. Awesome questions, and thank you all so much. Those are honestly 100% coming from people like you over the last week or two. Those all came through our YouTube channel, and I thank you if you submitted a question that we featured on the show. Appreciate it so much. Please keep watching. Please keep sharing your questions, and we'd love to answer your question in our next Mailbag episode. That'll do it for this week. Have a fantastic weekend. Go Seahawks in the NFC Championship against the LA Rams this Sunday. Wish you all stay warm, stay safe wherever you're at with the weather. I'm Dave Keller with Market Misbehavior, here to remind you, as always, it's always a good time to own good charts. Have a great weekend, folks. We'll see you on Monday.